Hello and welcome to the Richard Hunter interview in our new video-only format. I'll still be welcoming guests who know the city best to talk all things markets, and you can expect the occasional wild card to be thrown in there for good measure too. In this episode, I'm pleased to be joined by Gervais Williams, co-manager of the Diverse Income Trust, which is a member of our II Super 60 rated list. Gervais joined Premier Miton in March 2011. He is head of equities and manages a number of funds and trusts. His fund management career extends over 30 years, including 17 years at Gartmore Group, where he was head of UK small companies, investing in UK smaller companies and Irish equities. Gervais is a member of the AIM Advisory Council and a board member of the Quoted Companies Alliance and the Investment Association. He was a member of the Patient Capital Review panel with the Chancellor of the Exchequer, where the recommendations were put into legislation in the subsequent budget. Gervais has also published 3 books. So first of all, please could you remind us of the objectives of the Trust and what differentiates your strategy perhaps from others?
So it's an equity income fund. The Diverse Income Trust generates hopefully a sustained and growing income over time. The features which differentiate it from others are specifically it's really a multi-cap approach. It invests in mainstream companies in the UK as well as smaller companies which are coming through on the AIM market. And most particularly, it has an objective not just to generate good income, but hopefully more income growth over time than many others, which we believe will drag up the share prices and deliver a long-term return, which is better than most others in the peer group.
Okay, so how much do your percentages in large, mid and small caps vary and where are they currently?
Well, they do vary. It's interesting. I mean, in the FTSE 100, for example, we have had some smaller positions in the past. We happen to have a few more than we have at the lows. In the mid-cap area, we've actually had more and we've taken some profits on some of those holdings and we've got less weightings. Typically, and this isn't a fixed number, but often around 40% of the fund is in the FTSE 350 stocks, the mainstream stocks in the UK. But actually the largest cohort is often the AIM listed stocks. So often that's around a third of the fund and that's where it is at the moment. So most particularly it's a fund which is quite wide ranging. It makes a particular difference at times when actually we've got a potential recession because there are fewer companies generating good and growing income. And we've got the opportunity of investing in all of those companies which are growing good and growing income, specifically even if they're outside the mainstream stocks.
Now, we last spoke in June 2021, since when, of course, there's been a significant rotation away from growth into value stocks. How's that affected the performance of the Trust, particularly in the smaller companies which you mentioned?
It's interesting, actually, because what we've seen is investors becoming a little bit more confident. Markets have bounced to some degree. Some of the companies which are perhaps a little oversold have come up a little bit. I don't think we've seen a full recovery in the UK. The UK actually held up in stock market terms relatively well earlier in the year. FTSE 100 is still held up pretty well. What we haven't seen is significant movement yet in equity income stocks outside of the FTSE 100 stocks. So quite a lot of the smaller income stocks, whilst they've continued to trade pretty well, some share prices have sort of leveled off or even recovered a tiny bit. We haven't really seen the full recovery of those at this stage. So if anything, we believe there's a bit of a catch-up trade in due course as people start to move down the market cap range into some of the opportunities outside of the mainstream.
And is it fair to say that you need, when it comes to small companies, perhaps income is more difficult to find, or do you not trawl down quite that far in terms of dividend?
Actually, I'm not sure I would agree with that. I mean, clearly, people assume companies with paying income are mature businesses. And to some extent, there are some mainstream stocks which are relatively mature. But actually, as you move down the market cap range, you can find companies which are dominating a small area. And in doing so, they've generated not just the market position, but they've got surplus cash and they can afford to pay out good and growing income. So I think actually the opportunity of investing across a multi-cap approach isn't just to give us companies which are perhaps younger businesses, which are able to hopefully grow over the longer term. Businesses hopefully can grow even when there's a global recession on, but most particularly a wider range of different sectors, a wider range of different businesses, sort of younger and older businesses in different market sectors, which give us a wider range of individual holdings, which obviously diversify risk and ultimately help not just to produce a return, but obviously to manage risk along the way.
And talking along those lines of individual holdings, could you perhaps tell us about a couple of your current top holdings or positions and why you find them attractive?
Yeah, it's interesting, isn't it? I mean, when I was looking ahead of this, I was looking at sort of companies which are producing good and growing income, particularly where they've got opportunities which are unconstrained really by the global economy or interest rate moves, for example. And a good example of that is Mears Group. It's a company which actually is a market leader really in servicing the sheltered housing, the housing associations, those kind of areas. They have an outstanding level of service levels to their customers. It's been a tough time during COVID because obviously less volumes have been done by the business. But on the other hand, they've got a very strong business. They've also been helping to some degree with the streams of people coming in, applying for asylum and such like. So the volumes have been growing very nicely. The business is making plenty of profit. It's generating good income. But most particularly, we believe that actually there's a recovery prospect going forward as well in part of the housing association business as well. So there's a business which is already yielding 4.5, but most particularly where, if anything, they've got more customers than they can deal with. They have to actually, if there were customers who wanted to leave them, it's very easy to replace that. So it's a very resilient business, not a very highly valued business, generating income, strong balance sheet, but particularly a good and growing income from here. And that's obviously the key driver of us getting involved. Again, marketplace, which is quite exciting. And then further up the market cap range, it's not just about small companies. There are some large companies which are well positioned for recovery. Perhaps a controversial name might be Vodafone. Vodafone, as we all know, is a business which probably hasn't risen a lot in share price for many years. But we think with the data coming through, the IoT, internet, it's going to be, the volumes are coming through so strongly. And we think this company is very misunderstood at the moment. 35 billion market cap, but actually a yield of over 7, and the opportunities to grow at a much faster rate than most people think. It's not just down to the mobile and the usage of individuals. It's really about the data transfer across the cloud, which we are particularly excited by. Again, just a very overlooked stock. And it's those kinds of opportunities which get us excited.
And for Vodafone, there's been a bit of chopping and changing in terms of their strategy, has there not, geographically?
Yes, I mean, they have, obviously a European footprint, and they have made some changes, and there's question marks about whether they do or don't own their masts. But mostly, particularly, they've got this ability where customers are now dealing with very large amounts of data, and they are in a strong position, perhaps with some of the national power groups, to manage the grids with those groups. And the data you need at the time is so substantial, and they're in a position to make sure this data is collected reliably and allows the electricity networks to manage efficiently. And that's a really big challenge for many of the large power companies, on the basis that, as we keep getting electric cars and all the extra demands which are coming on the grid, it's a very, very challenging moment, and they're part of the solution, which is pretty exciting.
Yes, you're right. And of course, lest we forget, it's been around for so long, but the Internet of Things, of course, has so many applications.
Yes, and actually the data which it generates is just, mind-blowing, really. And it's not just the data, but you've got to collect it and reliably, obviously transport it across backhaul, particularly fibre, to the data centres. And that process is an area which I think is an area where I think Vodafone are very well positioned relative to many other competitors to take market share.
So, Gervais, with all of the foregoing in mind, obviously there are still any number of challenges on a global basis in terms of economics, recessions, rising interest rate environment, let alone inflation, of course. With all that in mind, but what's your sort of outlook from here, and how are you finding yourself positioned for that?
It's interesting. I mean, obviously, with the recent announcements from the Conservative Party that the Prime Minister, that they're going to start putting a lot of cash towards helping companies and the individuals manage the challenges with energy prices at the moment. If anything, that's quite a strong sort of injection of cash into the marketplace, a bit like we saw in March, April 2020. So the markets are fairly firm at the moment, and even in spite of a global recession or a UK recession, I think that's probably going to be there. But most particularly, I think, although there's room for markets to recover and mainstream stocks to recover, at some stage we think actually it's going to be companies outside of the mainstream which really deliver, companies which can grow when the world's not growing, companies which are able to be well financed at a time when perhaps some of the private businesses are more geared and more vulnerable to take market share. So ultimately we think that actually the UK market, which is a bit overlooked anyway, we think is likely to continue to outperform. But most particularly, many of the companies outside of the mainstream stocks, the top 350 stocks, we think are going to outperform what may be an outperforming market. We think very few sort of institutional investors are well positioned for this, as they have to change their position, as they have to start closing underweight positions, reweighting to the UK, and particularly reweighting in the companies which are going to outperform. We think the UK market won't just continue to be one of the more resilient markets. We think actually it's going to surprise on the upside. We're very excited about the potential for trusts like the Diverse Income Trust to actually deliver some very attractive returns over the long term.
And we like to finish on an upbeat note, and there you have it. So many thanks again, Gervais. That was Gervais Williams, co-manager of the Diverse Income Trust. So thank you for your time, Gervais, and for those valuable insights. And thank you for watching. By way of reminder, this show is free to subscribe. Just search for Interactive Investor on YouTube and hit the red subscribe button. And of course, you can find much more by the way of investment insight and ideas at ii.co.uk. I'll be back soon with another Richard Hunter interview. Bye for now.